Hello friends and welcome back to edupediaworld.com. In this session we continue with our discussion of national income by discussing the methods of measuring national income. Now this is a very important topic in this particular section. So discussing about the methods of measuring national income, basically it is determined by viewing the whole economy from three different angles. The first angle is that the whole economy is considered as an aggregate of productive units of different sectors such as agriculture, mining, manufacturing, trade and commerce, services, etc. And this angle gives rise to the net product method. The second approach is that the whole economy is considered as a combination of individuals and household which own different kinds of factors of production which they can use themselves or sell factor services to make their livelihood. And this approach gives rise to the factor income method. The third approach is that the whole economy is viewed as a collection of consuming, saving and investing units, and the economy consists of individuals, household, firms and government, and this approach gives rise to the expenditure method. So there are three methods of measuring national income and we are going to discuss all these three methods one by one. The first method is the net output or value added method. Now, in order to measure the national income through this method, it is divided into three stages. The first stage is we are going to measure the gross value, and this gross value consists of sectoral value of each sectors of production. As we have discussed that the whole economy consists of different sectors and these sectors are divided on the basis of the type of activity they are doing. So we are going to add up the values provided by all the sectors in order to get the gross value. Then we also have to estimate the cost of production, and this cost of production is done for each sectors after adjusting the value of depreciation. And last but not the least, we have to deduct the cost of production which is a result of the adjustment done of the depreciation from the gross value in order to obtain the net value of domestic products. So let's go through all the three stages one by one. So for measuring the gross value, what we need to do is we have to classify the whole economy in various categories, in various sectors, and which is done on the basis of nature of activities from which the product originate. Now this is a very difficult task because classifying into various sectors, it differentiates from country to country. And because it is done on various other factors also, such as availability of data, what is the significance of that particular sector in the economy, and what is the nature of that domestic activity. So this particular data actually differs from country to country. We can take the example, for example, in US there are around 71 divisions and subdivisions which are used to classify the national output, whereas in India, according to the Central Statistical Organization publication, there are 15 subcategories which are currently used in India. So you see that the data differs from country to country. Now after the sectoral classification has been done, what we do is we take out the gross output, and it can be calculated in two ways. The first method is by multiplying the output of each category of sector by its respective market price and adding them together. See, what we do here is, for example, we talk about agriculture sector, and we get a data that 10,000 units have been produced and the price of each unit is say $10. So in order to get the gross output related to the agriculture sector, we multiply the units with its market price. So it will be $1 lakh. The gross output will be The value of gross output will of agricultural sector will be $1 lakh. And similarly, we get this data for every sector. For example, trade, then commerce, then industrial units. We get this type of data. We multiply the units with the market price of each unit and we get this data. And in order to get the gross output, the gross value, we add all the sectoral data. So we get the gross value. This is one method. And the other method is that by collective data about the gross sales and changes in inventories from the account of the manufacturing enterprises and computing the value of GDP thereof. Instead of multiplying the units by its market price, we get the collective data of whatever sales has been done and whatever the inventories are left over from the accounts of the manufacturing enterprise, and then we sum it off in order to get the GDP. So this was the first stage. In the second stage, we need to do estimates regarding the cost of production. Now, the cost here are estimated either in absolute terms where input data are adequately available, or as an overall ratio of input to the total output. Where data is not adequately available, it is done by estimating the overall ratio of input to the total output. So this ways we get the cost of production, and we do certain adjustments for the depreciation of the assets. So we have to calculate the depreciation, and it can be done by estimating it at some percentage of capital which is permissible under the tax laws. So under the second stage, we calculate the cost of production by doing the certain necessary adjustments for the depreciation. The third step in order to calculate the net output is we deduct the cost and depreciation from the gross value. Whatever the cost estimate and depreciation estimates have been done, we deduct it from the sectoral gross output to obtain the net sectoral product, and then the net sectoral products are then added together. Easy? See, as I told you that for various sectors we determine the gross output. For example, agricultural sector, then trade, commerce, financial sector. For each sector, we get the gross output, sectoral output, and out of this we also estimate for each sector the cost of production and the depreciation. So we get the cost of production and the depreciation value, and in order to get the net product for each sector, what we do is we deduct the cost of production and depreciation from the sectoral output. Same ways for this, and whatever is the resultant amount, we add them all together in order to get the net output. I'm repeating it again. What we do is, for first we classify the whole economy into different sectors on the basis of the activities it is carrying. For each sector, we determine the sectoral output or the gross output, and from the gross output we deduct the cost of production and depreciation amount of each sector in order to get the net product. And then for each sectors we add on the net product in order to get the net output through value added method. Revising it again, now you will get it clear. The cost estimates and depreciation are deducted from sectoral gross output to obtain the net sectoral products, and the net sectoral products are then added together in order to get the GDP. Clear? So this was a net output or value added method. The next method to calculate national income is the factor income method or the factor share method. Under this method, the national income is calculated by adding up all the incomes accruing to the basic factors of production used in producing the national product. Now, so when we have to calculate the national income by this method, we simply have to add up wages plus interest plus rent plus profit. Now, wages accrues to labor, interest accrues to capital, rent accrues to land, and profit accrues to entrepreneur. So this is how we calculate national income. But in the modern economy, it is very difficult to make a distinction between land and capital on the one hand, and between ordinary labor and entrepreneur on the other hand. So for simplifying it further, what we have done is, now national income is supposed to originate from just two factors of production, and that is labor and capital. However, in some activities, labor and capital are jointly supplied, and it is difficult to separate the labor and capital contents from the total earnings of the supplier. So, what we do is we name one more factor of production, which is mixed incomes, where labor and capital cannot be separated. So now national income is a result of earnings of labor, capital, and the other mixed incomes. So under this method, we are going to see that what are the incomes to be considered under labor, what are the incomes to be considered under capital, and what are mixed income. And we add up in order to get the national income of the economy. So let's start with what are the labor incomes. Labor incomes will be taking into consideration the wages and salaries paid to the residents of the country, and supplementary labor incomes, and this consists of employers' contribution to social security, employees' welfare funds, direct pension payments to retired employees. And the next is supplementary labor incomes in kinds, and it consists of free health, education, food and clothing, etc., which is provided to the employees. So labor incomes will consist all these three categories. Next is capital incomes. Capital income will consist of dividends, undistributed before tax profits of corporations, then interest on bonds, mortgages, saving deposits, then interest earned by insurance companies and credited to insurance policy reserves, then net interest paid by commercial banks, then net rents from land, building, etc., royalties, profits of government enterprises. So these are the classifications under capital incomes. The next is mixed incomes. Now, what will this mixed income consist of? It will consist of incomes of farming enterprises, the sole proprietorships, and other professions. So, in order to get the national income under this method, first we'll see what are the labor incomes, the capital incomes, and what are the mixed incomes, and we'll add up these three in order to get the national income. So this was about the factor income method. The last method to find out the national income is the expenditure method or the final product method. Now, this method measures the national income at the final expenditure stages, that is, the expenditures which is done by the consumers, the government, the industries, etc. At that particular stage where they are doing their expenditure, we calculate the national income. In estimating the total national expenditure, any one of the following two methods are used. The first method is all money expenditures at market price are computed and added up together. The items of expenditure which are taken into account under this method are private consumption expenditure, direct tax payments, then payments to non-profit making institutions and charitable organizations, and private savings. So these expenditures are taken into consideration under this particular method. And the next method in order to calculate national income by expenditure method is the value of all the products finally disposed of are computed and added up to arrive at the total national expenditure. And the following items are being considered here: the private consumer goods and services, the private investment goods, the public goods and services, and the net investment abroad. So these are the expenditures which are considered under the second method of expenditure method. So these were the various methods of calculating the national income. Now, the methods which we have discussed in order to calculate the national income was, we were assuming that in those cases the economy is a closed economy. That is, there is no economic transactions with other economies of the world. Now, because all the economies generally are open economy in nature, so what we need to do is, after getting the result from any one of the method of calculating national income, we do the adjustments related to open economy. So now we'll see that how the treatment of net income from abroad is done. In measuring the national income for an open economy, the net results of external transactions is adjusted to the total. We have discussed this earlier also, that how do we adjust the net results. When we calculate the national income of open economy, so the first step is to get the national income considering that the economy is a closed economy, and we can use the net output method, the factor income method, or the expenditure method to get the national income of a closed economy. After that, we do the adjustments to get the national income of open economy. We do it like this: national income of closed economy, which we determine by using any of the three methods which we have studied to determine the national income. In this, if there is surplus, that is, exports are more than import of a particular country, we add those net incomes, that is, we add net incomes from abroad, or if there are deficits, then we deduct the net losses from foreign transactions in order to get the national income of a open economy. So this is how we do the adjustments. This is how we do the treatment of net income from abroad to the national income of a closed economy in order to get the national income for an open economy. See, we have discussed about three standard methods of measuring national income, that is net product method, factor income method, and the expenditure method. Now, out of these three, which method a nation should choose in order to measure its national income? We'll be looking to that now. See, we take two main considerations on the basis of which a particular method is chosen. That is, the purpose of national income analysis, and the availability of necessary data. Suppose if the objective is to analyze the net output or value added, then the net output method is more suitable. In case, suppose the objective is to analyze the factor income distribution, then the factor income method is more suitable. And similarly, if the objective is to find out the expenditure pattern of a particular nation, then the expenditure method is more suitable. However, we also need to see that whether the necessary data is available or not in order to choose a particular method. So, on these two bases, the choice of a particular method to determine the national income of an economy is done. So this was all about national income. We have discussed about the concepts related to national income, the methods and measures related to national income. Up till now, you must have realized the importance of national income, that how much importance does it plays in knowing the growth of a country. In the next session, we will be continuing our discussion of national income by discussing about theories of national income. Till then, have a nice time and thank you for watching Edupedia World videos.